Non-Techies podcast. I'm your host, tech entrepreneur, executive coach, and Chicago Booth MBA, Sophia Mafiova. My aim here is to help you have a great career in the digital age. In a time when even your coffee shop has an app, you simply have to speak tech. On this podcast, I share core technology concepts, help you relate them to business outcomes, and most importantly, share practical advice on what you can do to become a digital leader today. If you want to have a great career in the digital age, this podcast is for you. Hello, smart people. How are you today? Yesterday, I got to connect with some of you online, and it was wonderful. If you came to my masterclass on the top 3 tech concepts that all business leaders need to know to have a great career, then, my dear smart person, thank you very much. I loved answering your questions and teaching you yesterday. And now let's talk about today. Today, you're going to learn about tech on a macro scale. You will learn how tech companies have changed the stock market and what stock market investors do to figure out what inventions are a good bet to invest in and which are just hype. And a lot of stock market investors don't have backgrounds in tech, but they've clearly had to learn enough about it to make good decisions. This is why it's such a great fit for Tech for Non-Techies. But I don't want you to think that this episode is just for people who already work in public markets, because, listen, in order for a company to go public, it has to start somewhere. So this one is definitely useful for founders and for early stage investors like angel investors and venture capitalists. If you're listening to this, you already know that tech has changed every single industry in the world. So if you want to be a conscious and educated participant in the business world, and also if you have leadership ambitions, which I'm assuming you do because the people who listen to this are generally the very ambitious lot, you have to understand how tech companies make their products and their profits. Today, my dear smart person, you will learn from Richard Kramer. He is a renowned stock market analyst and he's the founder of Arete Research. He's very smart. I met him at a conference hosted by the Financial Times. As well as being smart, I think he's actually quite good looking. If you want to see whether you agree with my statement, you can watch the full interview I did with him in video format on the Tech for Non-Techies YouTube channel, or see excerpts of it on the Tech for Non-Techies Instagram, Facebook, and TikTok channels too. And on that inviting note, let's learn from Richard Kramer. Hello, Richard Kramer, and welcome to the Tech for Non-Techies podcast.
Thank you. Nice to be here.
I'm really happy to have you here because I saw you at the Financial Times Weekend Festival, and where you were speaking very passionately about the ARM IPO. And I was not the only person who, enjoyed it vociferously. I took a short video, uploaded it onto TikTok, and it was actually one of my most commented TikToks on the Tech for Non-Techies TikTok channel. So I thought, well, we've got to speak to this guy since, everybody wants to hear his opinions, apparently. So welcome to Tech for Non-Techies. And Richard, tell us, what is it that you do?
So, I'm Richard Kramer. I am the founder of a company called Arete Research, which was founded back in 2000 with the completely crazy idea back then of providing independent research to investors. By independent, I mean research that's free from conflicts of interest. This was born ahead of all the Wall Street scandals, which have been repeated many times over the past 20 plus years. But we really focus on helping investors understand what they're investing in without having a hidden agenda of trying to do financing or bring IPOs to the market, or we don't have any other reason other than to give our true and honest opinion, which unfortunately is somewhat in short supply in the markets.
So I know we have quite an MBA audience, but for those people who are maybe outside of that world, so in general, you would have a large investment bank like Goldman Sachs, which is your previous employer, which would advise companies on lots of transactions, and then they'll get very, very large fees from those transactions, which is why investment bankers have houses in South Kensington and the Upper East Side. And then they would also have a research arm, which is supposed to be independent and is supposed to say, well, we're completely impartial about how we tell investors to invest in stocks, which I thought never really made sense. But, people were getting away with it.
Well, it doesn't make sense. We call those analysts sycophants and stenographers because they're the ones who get on the earnings calls and asks, after saying congratulations on a great quarter to the management, they ask, and indeed the senior analysts from a lot of these big banks will ask the managers, how should we think about? In other words, I'm an empty vessel. Fill me with what you want me to tell the investment community, or I'm going to pitch you a softball question. And it is astonishing that after all these years, after 20 years after the Wall Street settlement that Eliot Spitzer forged to try to stamp out conflict of interest, you still have something like 80 to 90% of ratings from investment banks as buy and only 5 or 10% as sells. And that number goes down for the investment banking clients of the firm that might be issuing the research report. So that research is really marketing for financial services. It doesn't really try to be impartial in any way. It's there to sell stocks and not to point out the bad news. And if half the stocks in the market underperform, or even more, why is it that analysts have buys on 90% of the stocks that they're covering? And the reason is because of that conflict of interest. They don't want to upset a very valued corporate client who might pay a lot more in fees for a transaction than an individual investor, institutional investor client might pay to trade the stocks of that company.
So would it be fair to say that you consciously decided to go and become a very unpopular person?
It indeed, that wouldn't be unfair to say. I had an ethical view that frankly, research should be delivered in a fair and honest way without conflicts of interest. And it was before all the scandals that came out with Blodgett and Grubman and the Spitzer settlement. And indeed, in the last few years, I've founded a podcast called Bubble Trouble with my co-host Will Page, where we talk about the inconvenient truths behind the marketing and hype that goes on in markets. And a lot of analysts are really, frankly, they're the marketing arm of the investment banks to be the cheerleaders for stocks rather than to help investors really understand what they're getting themselves into.
I was actually just about to mention your podcast because I was listening to your latest episode on audiobooks, and apparently all the people who are listening to audiobooks are really old, sitting at home drinking cups of tea. Well, I have been drinking cups of tea at home and listening to audiobooks, so perhaps I'm old before my time. Mm-hmm. But Richard, so tell us, how did you get into this field? How did you get into analyzing tech stocks in the first place?
So I've had a lifelong interest in technology, but back in the years and years and years ago, because I'm very old, back in the years and years ago, that was looking at things like telecom technology. And, I really came of age as an analyst in the 90s when the wireless boom was coming in. If you remember, GSM phones when they first were coming out from the likes of Nokia and Motorola. I was there at the start of all that. So I had a long and abiding interest and fascination with media, with technology, and that morphed from being traditional newspapers and television and cable and satellite and telcos to what we have today, which is many internet-based technologies. And I'll tell you the wonderful thing about Arete and our work, and indeed our Bubble Trouble podcast, is that tech throws up tons of fascinating topics all the time. It has geopolitical ramifications. It has social and cultural and anthropological ramifications. And it has obviously profound economic implications in the sense that the five big tech companies that we all know so well and are such a big part of our life, the Amazons, Microsoft, Apple, Meta, and Google, or Alphabet, they are collectively $10 trillion of market value. And we have never seen in modern economies companies with this level of resources and power and sales and free cash flow. So it's a fascinating field. It never gets dull. Our tagline on Bubble Trouble is that if there's a bubble that bursts, we pricked it first. We've been very early in calling out things like NFTs, which we said back in March 22 were going to be complete nonsense. And So we're happy to apply a critical and skeptical view towards this technology, but also watch it with amazement because, if you were put in suspended animation back in the early 90s and you came out today and looked at what technology you had available to you, you'd say, first of all, why aren't all the phones chained to the wall anymore? And then you'd say, well, hang on a second, why is there a library available to me on my smartphone screen that's like the Library of Congress? I mean, the advances have been just phenomenal, and it's constantly fascinating to watch.
So to understand the career path, you went into finance, so you're working Goldman Sachs, but you were always interested in technology. So you consciously chose to work on the technology sector.
Well, I'm gonna say something that will probably upset many of your MBA audience because I've never studied finance. I regard it as something that up to a certain level of sophistication, you can just figure out with some basic application of common sense. And I've always been fairly good in quantitative work. So I never studied finance. I studied communication research, which was a lot of statistics. I took business school classes in economics and market structures, but I never went to business school. Saved myself a lot of money for that way. But I just found that by pursuing my interests and really focusing on what I loved and what I enjoyed, it led me down this 30-year career path of becoming an analyst and watching these technologies unfold.
So obviously, as a stock market analyst, you are constantly looking at what's happening in the markets, you're looking at tech trends, but also I am assuming that you are really looking at what's happening in smaller companies, at maybe even in academia, in terms of innovation, in terms of what are the new things that are being invented. And are you seeing a disconnect between what is actually being invented and essentially what's being traded?
So there is a constant disconnect between the sum total of inventions and the tiny fraction of them that have ever a commercial reality. There's inordinate number of examples where things that were promised to be, game-changing innovations turned out to be a fizzle or
Like,
nothing. And I think you had a great example of that. Well, so if you go back 2 or 3 years ago, everybody was, you had the largest corporations in the world were appointing a chief metaverse officer.
I know. I
And
about this on this podcast too.
And you just wanted to say, hang on a second. How many people want to put these bulky goggles on and delve into this artificial realm? And there are dozens and dozens of examples over the years we can point to. The quantified self and all these fitness trackers. Remember when everybody had to have a Fitbit or some other thing on their wrist, and now how many of us do? Maybe we have a watch which performs some of those functions, but you realize very quickly that there's one common error that's made in technology by the inventors, which is that they extrapolate the behavior of a highly educated upper middle class segment to the mass market. And I think podcasts are another great example in that whilst they have penetrated maybe further than people think, they are still a relative niche compared to the millions of people who get in their cars and turn on the radio, or who will listen to other forms of audio. I just don't want to oversell it. Now, the wonderful thing on the flip side is that you get so many brilliant ideas bubbling up from those small companies. They're the ones who don't have the 190,000 employees of Google and all the policies and procedures and legal structures that in a way stifle innovation. And so we spend oodles of time talking to small companies and entrepreneurs and academics about the work that they're doing so that we get a read on what's coming through. But let's face it, to commercialize these things at scale, it often ends up being the largest companies that win out just by sheer force of economic will, if not by just the sheer amount of resources they can devote to commercialization.
I'm actually just quite curious about the logistics of your day. Because if you are, are you curious about it too? Well, because if you're looking at large caps, right? And like that actually requires some work and intelligence and speaking to CEOs and doing some research. But then also, speaking to academics and startups that are not going to be listed or ever or not at all for a long time. How do you do it? Because as far as I know, this is not sort of a standard behavior for most equity.
Well, again, you have to step back and realize that most equity analysts are there simply to, I won't say put lipstick on the pig because not every company is a pig, but they're there to burnish the reputations of the companies that they cover. They're there to say nice things. So they may have a chat with an investor relations executive or the CFO of the company who will tell them, "Well, our big initiative is a plutonium-powered spaceship, which will be launching next week at a big event." And they want to get everybody excited about that, right? And they just dutifully write down, yes, did you say the moon was made of green? Did you say it was green cheese that the moon is made of? Great, fantastic. We'll put that in, company says they found green cheese on the moon. And you know, let's not oversell it. I mean, I don't talk to the CEOs of these big companies. They almost never engage with the analysts. They have a series of comms people or investor relations executives to do that. But those big companies are under something called Regulation FD, which is from the US SEC. They say the companies have to offer fair disclosure. They can't tell one analyst something that they don't tell the rest of the market.
Mm-hmm.
So what the companies will generally tell us is what they tell everybody else, and we're not going to get any special information from the company itself. In our research process, and at Arete, we have four broad areas. We look at semiconductors and all sorts of components. We look at software and cloud services. We look at telco, cable, and media. And my specialty is to look at internet and digital consumer companies. But in those four areas, we have to talk to many smaller companies about what are the interesting things they see coming through. They tell us a lot more. They're eager to learn what we've learned and to get our perspective on the big companies that either they're competing with or maybe they hope will buy them one day. So we are having this constant discursive discussion with the industry writ large. And the way we organize our work is around big themes. So, for example, we might look at the impact of AI on the cloud software space, or we might look at the impact of AI on the demand for various sorts of chipsets and how one builds data centers in the future. And because we're not required in our work to focus where 90% of the work of equity analysts go, which is on this nonsense quarterly earnings charade, the charade of the earnings call, and congratulations on a great quarter and beat or miss earnings estimates. We can look at things on a 1 to 3 to 5 year view and say, let's look at, to paraphrase Wayne Gretzky, where the puck is going to, not where it is right now, and skate there. So we try to find the themes that we think are going to be really important for investors to understand over a multi-year view, and we work our way backwards with the broadest set of inputs we can find. Whereas I think a typical analyst working at a bank is very narrowly constrained by having to look at the quarterly earnings and deliver a set of inputs, which is our earnings estimates are higher or lower than consensus, and they're going to beat and miss our numbers, and which is, to my mind, an incredibly boring and soul-destroying game to play.
So how much do your colleagues and how much do you have to learn about the actual technology being discussed in order to give recommendations that you think are going to make sense?
So we're never going to learn it to the extent that, if my colleague who I've worked with since 1997, who is one of the best semiconductor analysts in the world, I mean, he may have studied semiconductors and been an engineer in the past, but he's certainly not going to be deep in the weeds as an engineer would in inventing the technologies. But certainly, we have to be highly familiar with and, most importantly, solicit customer feedback on the technologies. So, for example, in our software practice, we talk to about 100 to 200 CIOs a year, chief information officers. Those are the buyers of software. And if you know anything about software, a lot of it is promiseware. This program will solve all your problems when we finish all the features on our roadmap out to 2027. Right. And so what we need to have is the real world feedback from the chief information officers saying, okay, this company is very poor at delivering on its roadmap, or they haven't built out these features. This other company has a very niche product, but it's incredibly useful for us. Or we've selected these companies for these various reasons. And, we want to understand the commercial side of the business, who's going to win the contracts versus who's getting displaced. and we want to understand the technology roadmaps and who's positioning themselves to grab what interesting end markets. And it doesn't necessarily require that we go deep down to the engineering level, but certainly for all of our senior analysts here who have 20 plus years of experience, we're very conversant with the way the various technologies work and their pros and cons.
Interesting. So you've chosen the word conversant. So they're speaking tech rather than doing tech, which is something that we,
yeah. And you know, look, I mean, I'm not an engineer. I certainly have looked at, you know, in the digital advertising space that I spent a lot of time at. I've looked at buying platforms and bought digital advertising, and I understand how the plumbing of the market works. But I would not be able to write the code that launched a new system. That's something that usually it takes teams of hundreds or thousands of people to do, and with a different skill set than I've got.
I really wanted to emphasize that point and to kind of bring that out of you to the listeners, because I think people who are especially studious, very studious, who just want to take lots and lots of courses, who understand that tech is important, they sometimes go down rabbit holes and end up learning a bunch of things that actually they don't need to know. Or maybe that they already kind of covered, but, you know, it was just called multiple linear regression at the time, but now it's, you know, a version of AI or whatever. And so I do want people to understand that, yes, you need to learn some stuff, but actually just sitting there doing course after course after course is not really going to get you where you want to go.
So I call that, and I find this a lot with the analyst community, I say that they're spending most of their time examining the lichen on the bark as opposed to missing the wood for the trees. And in that sense, you know, I would always encourage people to step back and look at things from a higher level of abstraction. Don't get too hung up and tied up in the weeds of things, to try to instead keep things in perspective. And again, you mentioned this. I think it might have been something we talked about prior to the podcast. You know, I hear AI and I think, well, hang on, this is machine learning. And I see machine learning and I say, this is linear algebra or regression analysis or statistics. So there's a very important role I feel that Arete has to play in demystifying and explaining tech to people, where we're not trying to use jargon. And one of my colleagues has this wonderful phrase. He says, you know, I ask every company, can you explain to me what you do in 3 sentences without using jargon? And if a company can't do that, then you know you've got a major problem.
And it's interesting because I think finance people mystify finance. I mean, my theory is to get paid more. And then tech people mystify tech.
100%. Yeah.
So then if you are an equity analyst of tech companies, you've essentially got these two sides of the market who are trying to sound really, really clever and really, really complicated, basically to, you know, extract cash.
Well, yeah. And look, and I don't want to, again, put this in too pejorative a light, because if you went back hundreds of years, there would have been guilds for leather makers or woodworkers or metal workers, and they would have all had their quote unquote secrets of the temple.
I mean, everybody does it. Chefs do it with their secret sauce.
But at the same time, I think uniquely in finance, most and many businesses are arbitrage businesses. They are trying to exploit a price differential, buy low, sell high, for example, or in the case of short sellers, sell high and buy low. And fundamentally, at the heart of that, there's an information asymmetry. There's something that someone thinks they know and thinks you don't know, or believes that you don't know. And whether you call that an edge, if you're a particular sort of fund manager and you're looking for an edge on a stock or a thesis on a stock, or you're simply an arbitrageur who figures out that the price for a nanosecond between Chicago and New York, as you could read about in Flash Boys, you know, is infinitesimally different, and you can exploit that with trading time stamped down to the 10th decimal. You know, there are always these information asymmetries, and I understand that people seek them out. I understand that people try to keep what they do as if it's completely impossible to understand and suggest that everything else is dead easy. But I think a lot of the lessons I've learned as looking at the markets for the past close on 30 years is just that, you know, to simplify things is always really helpful. And I think they're whether it's your investing maxims from the Warren Buffetts of the world, who, you know, first rule of investing is not to lose money. it's a very helpful concept.
Hmm.
Or that you can find some of these simple rules which help you keep things in perspective when people are trying to blind you with science or the financial equivalent of science.
That's actually one of the kind of inspirations, I guess, for Tech for Non-Techies. Is when I was doing my MBA at Chicago Booth, there was a professor, Per Stromberg, who was teaching corporate finance. And I was really terrified of taking his class, and I had to take it. So, like, I had no choice. But I was terrified because he was on the Nobel, and I think he still is, on the Nobel Committee for Economics. So he's one of the people who decides who gets the prize. And I was thinking, well, I don't think I'm going to, like, I was thinking, I'm not going to understand what he says. It's going to be a disaster, despite having worked for a private equity firm before. But
Right.
still, I was convinced it was going to be a disaster and I was going to completely embarrass myself. And yet, when I got to his class, he explained things in such simple terms. Things that I hadn't understood before were blindingly obvious. There was no jargon. We basically just had like a matrix of four different squares. And, if you filled in those squares, everything was clear and fine. And to my great surprise, I ended up actually doing really, really well. And then that's when I saw, okay, well, first of all, this is what good teaching is. That is literally
Yeah.
demystifying. But then I kind of had this realization that all these other people who'd been trying to explain things to me before perhaps weren't trying to explain things to me. They were just
Yeah.
trying to look clever, basically at my expense. And this is really what we're trying to do at Tech for Non-Techies. But let's move on to your moment of fame, Richard.
Well,
Your moment of fame when you were discussing what happened with ARM Holding. So, would you like to tell the audience just briefly what happened? And then let's go into some of the cultural differences between US, Europe, China, and so on.
sure. So you were one of a packed tent. I have to say I was very flattered by that. But it probably was my panelist and co-presenter, James Anderson, who's quite a famous fund manager in the UK. But famously bullish on tech. And I was there to be a bit the bear on tech. And there was another woman from a Canadian pension fund that invests in a lot of private companies. And we were having a panel talking about tech investing broadly. And luckily, we were on at a good time that we didn't have one of these. The guy, for example, who wrote the script for Succession wasn't on against us. So we had a good lineup in terms of who the other tents competing for people's attention. So we had a packed house, and we were talking about this very topical issue which it was just coming out at the time of the IPO of ARM Holdings, which was a UK semiconductor design company, which in 2016, after being listed on the stock market for 15 plus years, was bought by a Japanese company called SoftBank, which then proceeded to invest a lot in the company, changed its performance, changed its trajectory. But then when SoftBank needed the money, they brought it back to the market and re-IPO'd 10% of it. They did another IPO of ARM and brought it back to the market this last September. Now, the discussion was on several levels. First of all, it was the kind of broad discussion about should the UK have allowed a foreign company to come in and buy one of its crown jewel tech companies and tech assets? Would this have been allowed in the US or in Europe or in other markets? Interesting question. There was the question of whether, because ARM was listing not in London but in New York, what was the problem with capital formation in the UK that we couldn't find enough critical mass of tech investors here to pay whether it's realistic or crazy, the valuation that ARM's backers wanted to obtain, and why there wasn't a larger pool of tech companies for ARM to compare itself to in the UK market, where the FTSE 100 index is full of mining companies and banks and retailers and utilities, but doesn't have really any tech companies. So there's very, very few. There's a software company here and there, but not much. And the telcos, I don't think you think of necessarily as tech companies. So we had all these different dimensions of discussing this very topical IPO that was happening in the market. And I really said it's a bit of a tragedy that whilst you've had fantastic, unbelievable pools of resource and engineering and computer science education in many places in Europe, not just in the UK, but in Switzerland and Germany and France, etc. But it hasn't coalesced into creating the big tech players that are all now sitting in the US. And if you wanted to add the to those five that I mentioned before, the Teslas or Nvidias or Intels or AMDs, they're all US companies. And where are the European tech champions? Well, for every, occasionally there's an ASML or someone else that you would point to, but there's really not the native companies here that have stayed native. And I said that that was really a tragic outcome and quite sad that Europe hadn't been able to protect its national champions and nurture them the way that had been done in the US. And now I think that ship has sailed because the critical mass of tech investing is really sitting in the US. About 85% of the global tech market cap is sitting in the US right now, 85%. And whilst there are some phenomenal companies, whether it's ASML in Europe or TSMC and Samsung and others, Sony in Asia, all of the really big market caps and many of the smaller companies are sitting headquartered in the US.
And so why is that?
So there's a lot of explanations. One would be very finance led because it would be about the critical mass of finance capital in the US and the amount of money that was been made available from the Defense Department to DARPA and so forth to support tech companies and sort of the industrial policy approach. Now, the same industrial policy approach has been taken in Japan with much less success, certainly on the global stage. You can look at cultural explanations. English is the lingua franca globally, and these companies have done a brilliant job of figuring out consumer services they could offer for free, with your data being provided as in exchange. I would argue that if the NSA and CIA were really clever, they would have invented Facebook and Google because it allows the U.S. to keep 2 or 3 billion people under surveillance out of the U.S. every day. And I think China takes the same approach. But by and large, I would say it's a critical mass argument. And you can look back in history, whether it was silk weaving or ironmongery or what have you, and Silicon Valley, you need to have a critical mass of participants working in different firms, but coming together, exchanging ideas. Remember that it's only the last 20 or 30 or 40 years where those processes were really globalized. So they would need to be physically co-located before we all got used to remote working and distributed corporations. So I think you can point to a lot of different explanations for it, but it's facts on the ground right now. And I think the debate over ARM is really a tragic one because that ship sailed a long time ago and is now. You can't put that genie back in the bottle. You can't all of a sudden out of whole cloth magic up a European or UK tech industry because the critical mass of companies aren't here and there's too much of a weight of competing with the big American giants that the smaller European companies can't easily overcome.
But I also see a risk aversion, a kind of different risk appetite, especially at the private market end. So I have seen, say, UK investors basically ask for the kinds of projections of an early stage company that are fundamentally unrealistic. Like I can give them projections, but essentially they're all going to be made up. So what's the point? And also I've seen less of a desire to invest in marketing and marketing spend from UK VCs. And I wonder if it actually is to do with the backgrounds of venture capitalists, where US VCs, I saw some research that says that 68% of venture capitalists in the US have some experience of working in a startup, whereas in the UK, that figure is 8%. Actually, most people are investment bankers and management consultants who see venture capital as mini private equity and expect a kind of DCF analysis at a point where you have no cash. So you can't really...
Yeah, look, I don't want to overstate. Look, I think a lot of the VC industry on both sides of the pond around the world is fundamentally running a pimp prostitute business model where they try to exploit young companies and get a 400% IRR in 6 months. And they think they're being angels by spreading their bets, but they're getting a lot of backhanders, they're introducing their friends who are accountants or lawyers. They're running a network. And I think it's really a relatively rare set of VCs that are really deeply engaged in adding value to the companies they cover. Much like in private equity, you'd ask, is all the financial engineering of the owners of businesses, private equity owners of businesses, really adding value the way the managers who really know that business and how it should run can? And the answer is almost certainly no. So I don't want to necessarily say it's something cultural about VCs. I think there's obviously a much bigger critical mass of VC investment, and you can go back and say, why is it that European pension funds were slower to get into VC and private equity? You could also say, in the end, if you're going to see a lot of bubbles bursting, that they're going to be better off because they won't be invested in these ridiculous valuation startups. And obviously, there's a new gold rush in AI right now. That 2 years ago, everybody was investing in NFTs and the metaverse. So let's see how many of those AI startups are able to make it, don't have down rounds, run out of cash, or end up pulling the ripcord to the logical conclusion, which is selling themselves to one of the big tech companies that likely they left to create a product that they knew the big tech companies would want and they could sell back to them at a premium.
I am curious about this big tech concentration that we've got in the public market.
Yeah.
Because as far as I understand, basically big tech is fundamentally holding up the US stock market and has been for a while. Is that a fair assumption?
Well, again, I think the performance of the U.S. stock market has absolutely been led by the 7 big tech companies. And again, because of the sheer weight and preponderance of the market values of these companies, Apple at close to 3 trillion now, Google at and Microsoft and Meta at sort of 1 to 2 trillion, and Amazon, they are unavoidable. So one can't say, I'm not going to own any of those companies, because it's very hard to invest in the market broadly and not invest in big tech. Equally, when you stand back, those companies in the last 12 months have $1.6 trillion of sales. They generated about $260 billion of free cash flow, invested about $220 billion of R&D and about $160 billion of capex. So these companies are just constantly leading investment in the market, not just in the US, but globally. And so if you're thinking, when I buy stocks, I'm buying a proxy for, putting my money to work in the hands of someone else as a shareholder, that I'm going to be effectively supporting this company. I'm giving it, I'm giving it my backing so that they can invest and grow. It's kind of hard to find companies that are putting that kind of sheer amount of capital to work the way you have close to $400 billion of capex and R&D being put to work at big tech. And again, that kind of concentration allows them to spread their bets and to go very deep in areas like AI. And I think in the future, AI will be very much a battle for who has access to compute resources, who's able to buy chips and build data centers. And let's face it, when a Microsoft or a Google is spending $30 or $40 billion on capex, it's going to be hard for a small startup to be able to get their own NVIDIA chips and servers and power and networking and all that they need to or rent that capacity from one of Azure, AWS, or Google Cloud. So they'd be paying them anyway. So it's going to be very hard for them to match up. So we have seen in many areas of the economy this concentration. You have big agriculture, you have big pharma, you have immense concentration in the banking sector, too big to fail. And big tech is yet another area in which the antitrust playbook of the last 30 years has largely been stashed under the bed. No one's consulted it. And bigger is better and biggest is best has ruled. And you've gotten these giant behemoths of the tech industry, like you have in so many other areas of the economy.
Well, whilst that sounds very risky, I would say to listeners, well done for listening to this, because if you have a pension, you're going to be exposed to big tech, so you might as well learn something about it, right?
Absolutely. And it's hard to avoid it, because these companies, there's no other company in the world like Apple where a product launch every year is front page news. Mm-hmm. There's no other company like the Metas or Googles or Microsofts, which are regularly on the front pages of Financial Times, or can routinely make, as Microsoft did, a $70 billion acquisition of Activision. There's just not that many companies that have that kind of capital to put to work, and that I think all of them pass what Larry Page, one of the founders of Google, called the toothbrush test. It's a service you use twice a day. So if you're on WhatsApp and you're using Google Search or Google Maps and you have your iPhone and you're using Microsoft software in somewhere because it's kind of unavoidable, Amazon's a separate case. But those four companies, I challenge your listeners to avoid using them for days on end, unless you obviously go on one of those silent retreats for meditation that everybody should be doing after the detox from their MBA courses.
So, on that note, I'd love to find out, how can listeners keep up with you? Because there is the Bubble Trouble podcast. Is there a newsletter or something that essentially they can carry on learning from you? Or do we all need to subscribe to Arete Research?
So Arete Research, because it's a regulated business by both the U.S. FINRA, SEC, and the UK Financial Conduct Authority and the Hong Kong Securities and Futures Commission, we really can only provide our research to professional investors. We can't do stuff for individual investors. It's just the compliance burden of it ends up being quite heavy. We can do a bit of media, and this is, again, I'm not giving you any investment recommendations, or I can't really be seen to be doing that for compliance reasons. So the best thing is to listen to Bubble Trouble, and there's usually bits and pieces when we make public presentations at conferences that come out. But by and large, the best thing for an MBA to do is get on the buy side as an investor, and then tell your firm, how come we're not working with the guys who tell us the truth, as opposed to all the investment banks who are going to tell you just to buy everything, when you can all point to something in your portfolio where it's just one of those face palms, and you said, why did I believe the story on that one? Why did I buy this? Oh my God, what just happened? And I've got plenty of those in my own portfolio. So you always want to have a skeptical, critical view. And for professional investors, we're here to provide that as a business. Bubble Trouble is just something I do with Will Page, my wonderful co-host, as a hobby, and also to kind of get the similar messages out to the broader public.
Well, thank you so much, Richard. I really enjoyed this conversation, and I've learned a lot from you, and I'm sure so have our listeners.
Thank you very much. Thanks for having me. Wasn't
that interesting? If you found this useful, how about spreading some good karma and leaving this podcast a rating and a review? I actually do read every single review, and I treasure every rating like it was a diamond. So if you're loving what you're learning in this podcast for free, then please tell me by leaving a rating and a review on Apple or on Spotify. You can now leave ratings on both platforms. And if you want to transform your career and really thrive in the digital age, then come and join Tech for Non-Techies as a member. It is literally a no-brainer. Tech for Non-Techies is the only place I've seen where business leaders can learn core tech concepts and also then see how to apply them to have brilliant careers. When you join, you'll get access to all of our courses like Tech for Non-Technical Founders, Tech for Business Leaders, Introduction to Design Thinking, and so on. But I know that you are not just learning tech concepts for the hell of it. You are doing this because you want to have a great career and be proud of the work that you do. This is why at Tech for Non-Techies, we also have monthly expert sessions on topics like how to get paid more, very important, how to transform your professional brand to be seen as a digital leader, and how to use design thinking for career and venture growth. Isn't that cool? I think that's bloody brilliant. We also have guest speakers coming regularly to speak to our members, so many of the people you hear on this podcast have actually answered questions from our members in live sessions. This is why I always say that you cannot get access like this anywhere else. This is why our members tend to be very successful. Our members lead digital transformation, they create businesses as non-technical founders, and they become smart money investors. If you also want to thrive in the digital age, then come and join us. Go to techfornontechies.co/membership or check out the link in the show notes. On that note, thank you so much for listening. I love the time that we get to spend together, and I really do value your attention. So genuinely, thank you. I'm wishing you a wonderful day. Eat something delicious, enjoy yourself, and I will be back in your delightful smart ears next week. Ciao.